It's Wednesday, 19th of November, 2025. Welcome back to your news update on Blip Brief, small but almost everything updated every weekday. So let's dive right in. Tuesday's trading session. It was a real head-scratcher. We had this powerful six-day rally in Indian equities, and then suddenly the momentum just vanished.
It evaporated, yeah.
Exactly. The key indices snapped that winning streak and reversed course. Now, the Sensex is still up over 9% year on year, so what exactly pulled the plug on this run?
It was a very clear reminder that even strong domestic markets can't completely decouple from what's happening globally.
Okay.
The reaction on Tuesday was sharp. I mean, the Sensex fell by 0.33%, and the Nifty dropped by 0.40%. It couldn't break that stubborn 26,100 mark.
And the why behind it?
It was really a 1-2 punch. First, you had significant weakness spilling over from global markets. But I think more importantly, especially for capital flows, was this dimming expectation of a U.S. Fed rate cut in December.
Right. So we're still tethered to that global monetary cycle. But, okay, if that's the reality check for the stock markets, let's talk about a domestic story that isn't just checking expectations, it's completely rewriting them. I'm talking about that incredible inflation data for October.
This is the massive macro story right now. It really is a genuine policy milestone. It looks like India is entering a period of, well, a deep deflationary anomaly.
Anomaly is the right word.
The headline Consumer Price Index, the CPI for October, is frankly shocking. Year on year, it dropped to just 0.25%.
Wow.
And to put that in context, that's a decrease of 119 basis points from September. It is, in fact, the lowest year-on-year inflation figure we've ever seen in the current CPI series.
A 119 basis point drop in a single month is historic. For anyone maybe less familiar with the term, can you quickly explain what a basis point is and how deep this pressure goes?
Of course. A basis point is just 1/100th of a percentage point. So 100 basis points is 1%. When you hear a number like 119, that's almost a 1.2 percentage point cooling. It's a massive correction for 1 month.
And it goes right into people's daily lives, doesn't it?
It goes right into the kitchens. That's where it matters. The Consumer Food Price Index registered year-on-year deflation of minus 5.02%.
Minus 5%.
Yes, that's a drop of 269 basis points just from September. Another record.
That is just incredible price relief. So what was the magic bullet here? How did prices, especially food prices, collapse so dramatically?
It wasn't one single thing. It was more of a powerful alignment of policy and timing. Two things really working together.
Okay.
First, we're now seeing the full month's impact of that big reduction in the goods and services tax, the GST, across a lot of central sectors.
Right, they targeted food and transport.
Exactly. And second, we benefited from a very favorable base effect.
Ah, the base effect. Let's unpack that for a second. How does that contribute to what we're seeing?
Think of it like this. If prices were really high exactly 1 year ago, then even a stable or low price today looks like a huge drop in comparison.
So it amplifies the success.
It absolutely gives it a policy tailwind, yes. And you can see the practical impact. Transport and communication inflation, for instance, is now down to 0.94% from 1.82% in September. That's immediate relief.
The significance here for the Reserve Bank of India, I mean, it must be huge. Does this give them room to focus back on growth?
Precisely. This gives them substantial latitude. When price stability isn't this immediate, overwhelming problem, the RBI can shift its gaze almost entirely toward bolstering economic growth. It gives them options.
That flexibility is critical. Okay, let's shift from that big macro picture to some of the corporate fault lines we're seeing. There are some concerning reports about the microfinance sector.
Yes, that stress is very real. And it's a threat to financial inclusion. We're talking about microfinance institutions, MFIs, that lend small amounts to low-income borrowers.
And they're in trouble.
The reports are that about half a dozen of the smaller, undercapitalized ones have actually defaulted on their own bank loans. They've been battling asset quality stress for quarters now.
That threatens their survival.
It absolutely does, especially the smaller players who serve the neediest parts of the economy.
Okay, so from distress to dominance. We also saw a major infrastructure deal get finalized this week.
A complete strategic contrast, yes. The creditors for the bankrupt conglomerate Jaiprakash Associates have unanimously voted for the bid from Adani Enterprises.
They beat out Vedanta's offer.
They did. It just signifies Adani's really clear focus on consolidating control in critical infrastructure.
And it seems like big overseas investors are validating that strategy.
That's right. You saw GQG Partners, the global fund manager, increasing his holdings in 5 Adani Group companies through block deals. That includes flagships like Adani Energy Solutions and Adani Enterprises.
So the big money still has an appetite.
A huge institutional appetite, yes. But conversely, not all lenders are doing so well. Look at Credit Access Grameen. Their stock has lost nearly 10% since late October.
What's the pressure point there?
The concern is all about what's called portfolio at risk. Basically, the percentage of loans that are overdue and likely to default. Investors are worried about higher credit costs because that portfolio at risk just isn't improving as quickly as they'd hoped.
So they might have to write off more loans.
The market is pricing that in, yes.
Okay, let's connect this back to the global environment. You said Wall Street weakness fueled India's reversal. What's making U.S. investors so jittery?
The nervousness is, it's palpable.
Yeah.
The S&P 500 just marked its 4th straight day of losses.
And the anxiety is about what? Valuations?
It's twofold. First, yes, concerns over what many see as lofty equity valuations, especially in those high-flying AI-linked tech stocks. Are they overvalued? That's the question.
And the second part.
The second is what we mentioned earlier, those dimming prospects of a December interest rate cut. So everyone is basically in a holding pattern, just waiting for NVIDIA's earnings and key government data.
And when that kind of risk aversion takes hold, you see capital move around. What did it do to currencies and commodities?
There's a classic flight to safety. In currencies, the Japanese yen strengthened. That's your typical safe haven asset. The U.S. dollar held firm, reflecting that uncertainty.
And the riskier assets.
Well, the most telling signal was probably in crypto. Bitcoin fell below that key $90,000 mark for the first time in 7 months. That tells you risk appetite is really drying up everywhere.
Did that instability push oil prices up?
Not really. Oil prices actually dipped slightly. There were some supply disruption concerns, maybe linked to Russia, but rising U.S. inventories just reinforced this idea of a temporary oversupply. It tempered any potential gains.
Speaking of Russia, that brings us to a really serious geopolitical pressure point for India's energy imports. We're seeing a huge plunge in Russian oil shipments.
The plunge is dramatic. We're talking a drop of 2/3 in November alone.
2/3. Why?
It's a direct result of Indian refiners being extremely cautious.
Oh.
The U.S. has intensified sanctions, specifically targeting major Russian exporters like Rosneft and Lukoil.
And the fear is secondary sanctions, right? It's not just about who you're buying from.
Exactly. It's about the entire infrastructure of trade, the banking, the insurance, the shipping. Refiners worry they could lose access to dollar financing or, crucially, Western shipping insurance. That risk just forces them to stop buying or demand massive discounts.
That same friction seems to be playing out on the trade front, too. The U.S. Congress is pushing back against Indian tariff.
It's a very public negotiation, you could say. You've got a bipartisan resolution in the U.S. Congress calling for a stronger partnership, pushing for speedy tariff removal.
But India's response?
Well, Commerce Minister Piyush Goyal has been very clear. He said, good news on a trade pact will only come when the terms are fair, equitable, and balanced. It signals that India is negotiating from a position of confidence now.
That confidence seems to be underpinning a major structural change at home, too. I'm talking about the complete overhaul of the direct tax system.
It's a massive undertaking, and it's going to affect every single taxpayer. We're talking about the new Income Tax Act 2025, which is set to be effective from April 1st, 2026. The entire goal is just to simplify and modernize.
What's the biggest simplification for, the average person trying to file their taxes?
The biggest relief will be getting rid of the confusing concepts of assessment year and previous year. They're being replaced with a single, unified concept, the tax year.
That sounds small, but I imagine it's a huge deal.
For anyone in compliance or accounting, it's a massive headache removed. It just aligns the period you earn the money with the period you're assessed on it. It's long overdue.
And beyond language, how is it modernizing for the digital age?
It's quite ambitious. The Act is removing hundreds of obsolete provisions, and most critically, it's going to formally define virtual digital assets, VDAs.
So cryptocurrencies.
Cryptocurrencies, NFTs, you name it. By providing legal and tax clarity, it's moving these assets out of a regulatory gray area and into the formal economy. It's a huge step.
That clarity is essential.
Mm.
Okay, let's wrap up our deep dive. We'll move from financial law to our innovation brief, a major scientific breakthrough in the last day that offers some real hope.
Yes, there's been some incredible progress in the treatment of type 1 diabetes. New stem cell therapies are showing truly remarkable results in trials.
Okay, so explain the basic mechanism. How does this therapy actually work?
The idea is actually elegantly simple. It's replacement therapy. In type 1 diabetes, the body's immune system destroys the insulin-producing cells in the pancreas.
The beta cells.
The beta cells, exactly. So these new therapies are designed to generate new, healthy beta cells in a lab. They're then transplanted into the patient. The goal is for these new cells to just take over the job.
And the ultimate promise here, what are the trials showing?
The promise isn't just better management, it's potential freedom. These therapies offer patients the real potential to achieve insulin independence.
Meaning no more daily injections.
We are moving toward a future where the daily burden of monitoring and injections could become obsolete. It's a fundamental shift from just treating the disease to potentially curing it.
Insulin independence. That is a truly profound note to end on, a fascinating look at the forces shaping our world today. And just before you go, a quick note. This deep dive commentary was put together using advanced AI. We always strive for accuracy, but please do cross-verify any crucial information yourself. Your informed decisions are what matter most.